Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be analysing Microsoft stock. We'll be using TIKR terminal to go through the financials, and then I'll sit the numbers into a DCF and we'll come to a fair value of their stock. Let's get straight into it. So who are Microsoft? So Microsoft is an American multinational technology corporation, and it produces software, electronics and PCs. So if you don't know who Microsoft are, get out your cave, because you know who Microsoft are. They have all sorts of different products for Microsoft Office Suite, Excel, Word, PowerPoint, the Windows line of operating systems on all PCs, apart from MacBooks, etc. Apple products. They are basically everywhere. They also own Xbox and all sorts of different other products. The company was formed by Bill Gates, that's well known. More interestingly, recently they bought LinkedIn and Skype. But yeah, they are a part of the NASDAQ 100 and they are a component of the S&P 500 index. Now let's have a look at the sales for Microsoft, and we'll start with the sales per business. So cloud makes up 36%, personal computing 32%, productivity and business processes 32%. Sales per region, so this is interesting. It's basically 50-50 between United States and the rest of the world. So there's very much an even split between the US and then the rest of the world. It's good that we don't have all the revenue in the US as well, so that's a good sign. Now let's have a look at the financials for Microsoft, and we're going to be using TIKR terminals to do this. So yeah, let's have a look through it. So income statement to start with as always. So let's have a look at the revenue over the past 5 years. So revenue has increased by, it's not quite double, but it's going to be nearly double, isn't it? I'm guessing 2022, unless you have a really bad year, they're likely going to have doubled the revenue in about 6 years, so that's really awesome. The past 4 years or so we've had mid-teens double-digit growth, which is mad for a company of its size. It's actually remarkable how much these big tech companies have grown. So net income, very profitable business here. The profit has more than doubled in, 5 years, so awesome stuff there from Microsoft, really good. The share count is down slightly as well, so they are buying back shares. If this is the right capital allocation decision, who knows? If a company is overvalued / not at a good price, returning cash to shareholders via buybacks is value destruction in my opinion, but companies tend to do it anyway. But look at this cash. There's a lot of cash on hand for Microsoft, isn't there? Yeah, that's just a lot. We might have the most cash on hand in the world. Well, probably Apple does. We'll have to do an Apple analysis at some point, but this company isn't going bankrupt, let's just say that. Let's have a look at the debt though. So yeah, long-term debt and capital lease is about 71 billion. The cash can pay it off, instantly, so it's no big deal. Return earnings have all been going up. Just a lot going on here. Just lots of cash being generated, what we love to see. Cash from operations now, minus capex, that's free cash flow, the most important figure when valuing a company. And free cash flow, yeah, that's grown as well the past 5 years. We'll see from my analysis a bit more clear, but cash flow from operations is rapidly going up. Capex isn't going up too much, so that means free cash flow is going up, so we love that. Let's have a look now at what cash we've been dishing out. So buying back shares, as we said. Dividend as well. They do have a dividend to Microsoft, so increasing the dividend, that's always a good thing. Returns on cash to shareholders. Ratios now, so return on capital is very high, way above where I like to see it, in 2021 especially, and latest 12 months 34%. That is pretty decent. That is pretty decent for a company of this size as well. Just very high quality. Gross profit margins has also been increasing. Net margins as well, just awesome stuff. Well, it will be interesting to see if they can maintain these margins, but if they can, yeah, high quality, isn't it? Let's have a look at the debt now. Current ratio above 2, so there's no problem there. CCC has been negative the past year, so essentially what this means is their suppliers are cash fans in their business, because the way they've got their terms set up, it means they get paid quicker than they are paying suppliers, so essentially their suppliers are cash financing them. That is really good. It looks like this has been improving as well the past few years. If they get the sales in a lot quicker, then we have to pay people out. So yeah, that's always a good thing. It's always a good thing. And it's something I've been paying more attention to in my analysis. Because high quality businesses have a negative CCC. The lower the CCC, the better. And obviously negative is wonderful. Debt to capital, currently at 37%. So you want this to stay the same. You don't want this to get any higher. But if we compare the long-term debt off with the cash, so it's maybe not too much of an issue. But yeah, if you like the look of TIKR Terminal, I've got the link down below. Click it, sign up for my affiliate link, and happy analysing stocks, because this is a fantastic platform. You've got all of these different things to look at as well. I just go through the financials. You've got stock screenings, you've got global screenings for companies worldwide in lots of countries, news, analyst estimates, transcripts. Honestly, it's fantastic. So link down below, sign up to TIKR, happy analysing. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's have a look at the genuine impact stats for Microsoft, and we'll start with the quality metrics. So yeah, this is one of the highest quality stocks I think I've analysed, so 306. It's got the shield around it, so it's one of the highest quality stocks on their platform. So profitability very high, financial strength strong, capital allocation sound, and value wise it's looking very expensive though, unfortunately, which we'll come to see. Income statement, well, it's just looking expensive across the board. I don't need to go through it. It's just looking very expensive. Historical growth high, you know, that's pretty obvious from what we've seen, but it's cool to see it on this different format. So basically, very high quality business, but it's looking overvalued. So I think we know what we have to do. We have to wait until it gets to the price we're happy with. But some interesting insights there from genuine impact. Now let's have a look at my analysis checklist for Microsoft. And yeah, this company is nearly 2 trillion market cap, current price of $260 per share, current P/E ratio of 27 and earnings yield of 4% if you round it up. So my first pillar, so I want a company to be profitable, high returns on capital using low leverage. You can see from the green, this company does this. Microsoft hits all the boxes, so high returns on capital, 5-year average, lots of profit margin here, so gross profit margin is extremely high, net margins and free cash flow margins are high as well. So you can't complain at all here. Current ratio is above 1, way above 1. They've got double the current assets versus the current liabilities, so they can pay their short-term obligations extremely easily. Cash conversion cycle is below 60 days, so essentially the full cash conversion cycle takes 16 days, 5-year average. But as we saw, I think it's on here, so yeah. The past year and then last 12 months, minus 15 for CCC. So I'm expecting this figure over time to go up. We're doing something right out there. We're getting cash through the door very quick. Total debt to capital 37%, more than manageable, and they can pay all their long-term debt with their cash on hand. Awesome. Proven ability to grow, all green. Pretty obvious to be honest, but love to see it. Great capital allocation. So all green once again. They've been repaying long-term debt, they've been decreasing the shares, they've been growing the dividend, and my good acquisitions pillar, so gain on asset sales versus asset write-down and goodwill impairment. So looks like they've sold some assets and they've got some money for it. They haven't made any bad write-downs, because bad write-downs mean bad capital allocation from the start. So it looks, let's give Microsoft the benefit of the doubt here. They've done some good stuff, it looks like. It's a quality score of 100%. I think it's the first proper 100%. I did Meta. That was a fake 100%, wasn't it? Microsoft is the true 100%. True 100%er here. Buy at a fair price. So all of these metrics can be green, but it doesn't mean I'm going to buy the company. If the company isn't a fair price, it doesn't make sense as a purchase. So P ratio of 27, price to free cash flow ratio of 35. Put it simply, still overvalued. So DCF valuation with 10% return, I'm looking at a share price of $155 per share. Current share price of $260 per share. Needs to fall 40% still for me to be interested, and I'd need a margin of safety on that. So yeah, put it simply, Microsoft is absolutely fantastic quality. I would love to own them, but you've got to pay the right price, same as anything. So yeah, let's have a look at my DCF, and I used analyst estimates from Market Screener. I think we're also available on TIKR as well. All the data comes from S&P Global. So yeah, free cash flow going into the future, then a growth rate of 2%, extremely conservative, but I do it for the same thing for every single company. Current share price of $155, adjusted for net cash, and yeah, so it just needs to fall, essentially. There's not much more to say apart from that. Let's have a look at the share price. Let's see how much it's fallen in the past 6 months. So yeah, it's already, at one point it fell 29%, and now it's fallen 24%. So yeah, simply, it's got to fall a lot more. Microsoft needs to fall quite a bit more for me to be interested. Quality wise, it ticks all the boxes, just needs to be a better valuation for it to make sense. So there we have it, that was my full stock analysis for Microsoft. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.